Okay, good morning. Time now, a minute past 8 a.m. On the Thursday, November 14th, 2024. Welcome to another edition of the World Bank Tokyo online morning seminar. My name is Koichi Omori. I am Senior External Affairs Officer of the World Bank based in Tokyo. We organize these online morning seminars to introduce the latest World Bank report presented by the authors of those reports in a timely manner. Every spring and fall, the World Bank's Development Economics Vice Presidency Development Prospect Group is putting together the commodity market outlook. This is the periodical report to monitor the situation and prospect of the commodity market with the analysis of the, I think, 46 prices, commodity prices globally. And then this time we are featuring the commodity market outlook, which was released about 2 weeks ago. We do have three economists from the Development Economics Prospect Group this morning, connecting us from Washington, D.C. We have Paolo Agnoloulich, and then Jitendra Kadan, and then David Mekonnen. Three of them, all of them are senior economists in the Prospect Group. They will be presenting the main findings, main messages of the commodity market outlook, October 2024 edition for the next probably 35-40 minutes. After their presentation, as usual, I'll read the questions that we received already from some of you. If you did not have opportunities to send your questions in advance, please do so by putting your question in the online form posted on the announcement page of our website, or you can simply send your question to me by email, or you can put your question on the chat section of the YouTube screen. I'll read your question on your behalf following the presentation that you are now going to listen to. So with that, I would like to invite Paolo, Jeet, and David to come in to formally kick off the presentation. Over to you. Thank you very much.
Thank you, Koichi, and thank you to all of you for inviting us. It's a pleasure to talk about the commodities, commodity markets, and in particularly the findings and the insights from our commodity markets outlook. This is the work. This represents the work for quite a few of us. And in addition to Jeet, David, and myself, John Butts work on it, Phil Kenworthy, and AMSA has authored the special focus. There in each CMO, in each commodity markets outlook, there is a special focus, and this time around, Hamza Zahid is the author of that section. If we can move to the next slide, just talking about the structure of what we are going to talk today is really recent developments, outlook, and risks in relation to three commodities: energy, presented by myself; agriculture and food, presented by David; and finally, metal and minerals, presented by Jeet. If we start then with a brief overview, in the next slides, this shows prices for the three group of commodities: energy, metals, and agriculture. What we can see, apart from the considerable decrease from the level of prices in 2022, what we can see on the left, right is also prices kind of edging up in the last few months. That has certainly happened to energy, and in particularly oil, although it recently came back down. Applied also to metals, and in particular there was the impact on a number of metals from the recent policy measures in China. And we see a slight increase in the case of agriculture, but our colleague David will kind of zoom on that and mention that this kind of a recent decrease in October has already kind of faltered and come down. The message that coming from the CMO is really a message of prices continuing to fall. in 2020. They have been falling in 2024, but they will keep falling in 2025 or 2026. The intensity of the fall is different across commodities. You can see on the right-hand side, on the right chart, you can see that energy, the blue line, is decreasing quite substantially, less so in the case of metals, and again, less so in the case of agriculture. And my two colleagues will zoom into these two commodities, commodity groups actually. And in the middle is a brief chart just showing the correlation between China growth and the growth in commodity prices. What the message which comes from the chart is, historically, when China's growth has been substantial, like in the fourth and the fifth quintile, then commodity prices have increased also substantially. And that is a correlation analysis, no causation, but it's something to bear in mind, especially because we will be talking a lot about China in this specific presentation. And the message is a relatively weak growth in China, and again, relatively price falling, which is actually what we see also from this chart. If we move to the next one, is a bit of more details on the amount of the fall. About 6% in 2025 for energy prices, then only 2% in 2026. The Brent oil price is supposed to average 73 in 2025, down $7 from 80 in 2024, and edging down a bit in 2026. Agriculture, substantial fall in 2024, but I'll leave that to the wheat to give you the details. What we can say at this stage is for a further fall in 2025, and then some stabilizations in 2026. Metal prices is perhaps a bit slightly breaking this trend, as we expect it to be steady in 2025, but then falling in 2026, again due to the weak demand in major economies. This is our baseline forecast, but with each forecast there is a sizable amount of risk associated, and in particular we have escalation in the Middle East, a considerable upside risk for oil and gas. Weak economic activity is a risk for a number of commodity groups, not only energy, in particular energy and metals, to less so for agriculture. And OPEC plus cuts, and what will happen to those cuts is a key determinant in the oil price. And in the case of natural gas, that is a very seasonal demand, especially in Europe, where it's used for heating. Same applies to the United States, for example. And as a consequence, there is a weather risk associated to natural gas. And weather risks also are very prevalent for the next commodity group, which is agriculture. And we too will talk about the intensity of La Nina as a downside risk, but there is not only La Nina, there are also upside risks related to weather, in particular heat waves, which can affect the productivity or the crop yield, essentially productivity of agriculture sector. There is also other risk related to the fact that energy, oil and gas are used. Oil and natural gas are used as an input for in the agriculture sector, but also in the fertilizer sector, which is also an input for agriculture. And for metal, the main risk is really related to China, and that will become clear when Jitu will talk about the share of metals which are consumed in China. If we move to the next slide, and now we are focusing on energy. Next one. Here is really kind of discussing presenting the kind of the main prices in energy. Overall, we had a small decrease in energy prices in the last quarter, so in 2024 Q3, but that is That is mainly driven by oil. As you can see, Brent went down considerably, especially in September, went up again in October, and went down again in November. And natural gas prices very much depends on which market one is looking at. Pretty flat in the United States, the blue line, but clearly increasing in Europe as a consequence of increasing competition for LNG. And these days, after the Russian invasion of Ukraine, LNG, the price in Europe is very much linked to LNG. And coal prices, as shown, have slightly increased, in particular for the Australian benchmark. If we move to the next, then we focus on oil price in the next slide. And here it becomes clear there are three main determinants of the oil price. We have supply management, OPEC plus, and weak demand, in particularly from China, and geopolitical risk. Geopolitical risk is among these factors the only one prodding prices upwards. And that has been a very important determinant, especially in October, when there was some considerable uncertainty about the possibility of the oil infrastructure in Iran being attacked. And economic activity, a number of disappointing updates over the summer, particularly from China, as I mentioned, but also in the United States, especially the employment report in September. Structurally, on a more long-term basis, the discussion is really about weak demand in 2024 and 2025. You can see in the chart, the one on the right, that is the additional amount of oil consumption in 2024 and 2025. That is about half of what we have seen in 2023, and considerably lower than the average that we saw in 2015, 2019. And if we move to the next one, that shows that this weak demand is related to lack of additional demand in advanced economies. On the left-hand side, we see the yellow line very much flat, but also China has considerably deflated. The additional consumption in China has considerably deflated. EMDs, the red line, continues upwards, which is perhaps to be expected, and that is driven very much by the SAAR region, the chart in the middle, the South Asian region, also by the Middle East, and to an extent by essentially Asia Pacific, excluding China. Demand in India, so on the right chart, is pretty healthy, one would say, driven very much by the industrial sector, so naphtha and diesel, and also some LPG. And the additional demand in India in 2024 and 2025 will be very similar to the additional demand in China. And that is as first time that this is happening. If we move to the next one, please. We have spoken about demand. We spoke about demand in the previous slide, and now it's time to think about supply. There is plenty of supply of oil. That is the nutshell, the main message I want to pass you from this slide. It comes really by advanced economies, and particularly in North America, United States, and Canada. Also, Brazil is helping, and Guyana as well in Latin America and the Caribbean. As a consequence of relatively weak demand and robust supply, we expect a considerable excess supply, a considerable surplus in 2025. The chart in the middle, you see four big blue bars, and that is the amount of excess supply, the amount of surplus. So it's on average about 1.2 million barrels per day throughout 2025. This is substantial. This is something sizable, And this doesn't take into consideration the fact that OPEC Plus can return to the market 2.2 million barrels per day. So we have an additional supply from OPEC Plus, which can make its way to the market. And that would be, in a sense, reflective of the fact that OPEC Plus has a very considerable amount of spare capacity. If we move to the next one, this one is talking about kind of presenting the situation for the natural gas market. In this case, what is noticeable, and especially is perhaps of very much interest to our audience, is that the additional demand in 2025, 2026, and 2024 very much comes from the Asia Pacific region. And that is about like 50% of additional demand in that year. And overall, the conditions in the natural gas market are expected to remain tight, with additional supply just matching additional demand. Next one, please. And this is just mentioning about the redirection in LNG. We had a redirection from of United States LNG into Europe as following the Russian invasion of Ukraine. This has been partially reversed, with more gas going to the Asia Pacific, but also to the Latin America and the South Asia region, due to the booming demand in those countries. If we move to the next, that is briefly about coal. Coal, there is a possibility of having peak coal, global peak coal in 2024, and that is a reflection of the expectation that in 2025 coal consumption in China might decrease, is expected to decrease. In India, we still have increasing demand for coal, but not as much as the decrease in China, and therefore we see a kind of a gently sloping global consumption for coal in 2025 and 2026, sloping downwards. And then on the next slide, then we are talking about the forecast, really, oil price forecast. So as you can see on the first graph, we expect the 2024, the average Brent price to be about $80 per barrel, decreasing to 73 in 2025 and 72 in 2026. When we shoot the forecast, our kind of a view was considerably lower than the consensus. You can see the kind of the orange broken line in that chart. This has now shifted downwards, so we have kind of other analysts in the market catching up with us, or catching up with our view of the forecast, which is helpful. This forecast is related to a number of risks. Let's say ordinary risks is really kind of a weak demand in China, which is kind of is shown by the very low PMI reading on the blue bar, on the blue line for manufacturing. That has been contraction for the last 5 of the last 6 months. Only in October we just went barely above 50, which is the line between expansion and contraction. Also, another risk to the forecast is related to oil production in the United States. We assume that 500,000 barrel extra production in 2025 and in 2026. That might present some challenges to oil shale industry in the US. If we move to the next one, there is even more serious risks though in the oil market, and 2 of them. we identified one upwards, one downwards. So on the upside, conflict escalation in the Middle East. Now, conflict, the conflict in the Middle East has had so far limited impact on the oil price. There has been a considerable short-term impacts, kind of, increasing considerably and then decreasing, after a few weeks. And that is due to the fact that the oil production hasn't been affected. And this scenario instead assumes the reduction of 2 million barrels per day from that region due to some conflict-related event. And if that was to happen, we would expect the oil price to be about 84 in 2025, so $11 up from our average from baseline forecast of 73. The other concern is related to OPEC Plus essentially reversing the voluntary cuts which have been announced in November 2023, so 1 year ago, exactly 1 year ago. And if that was the case, if that amount of supply were to be made available to the market in the way that OPEC has announced it would do, then in that case we would expect price in 2025 to be $66, so $7 lower than what we expect in the baseline. If that amount of demand of supply was to make to the market, on the right hand side you can see the difference between the yellow line and the red line. That would be the amount of surplus in the market. That it would be extremely sizable. On the next one, and finally in my last slide, just talking about briefly on risk to the forecast for natural gas price. In this case, any delay in the liquefaction capacity in the US would be a serious constraint to the possibility of US increasing exports of LNG. And if that was the case, we would expect higher prices for LNG, also for the European benchmark, and lower prices for the US benchmark, because there would be less demand from abroad for the United States, therefore lower prices. Finally, if those of you interested in global peak coal, that sort of possibility relies very much on the decrease in coal consumption in China, and that decrease will rely very much on limited additional demand for electricity in China, and in particularly good output from hydropower, solar, and wind. If there wasn't sizable output from hydropower, solar, and wind, then coal plants will be very much called upon to fill the gap, to fill the generating gap, and therefore that would make achieving global peak coal in 2024 much more unlikely. Next slide. We are done with the energy section, and I'll pass it to my colleague David, and he will talk to you about agriculture.
Good morning. Thank you, Paolo. Thank you again for inviting us to make this presentation. I'll talk a little bit about agriculture, focusing on food and agricultural raw materials as well. The next slide, please. So agricultural prices in the third quarter of 2024 have edged up a little bit, have softened a little bit, but they have increased if you compare 2024, the third quarter of 2024, with a similar period in 2023. Agricultural prices have edged up by about 3%. And that is primarily due to historically high beverage prices, What you mean by beverage prices in the commodity markets refers to basically cocoa, coffee, and tea, and particularly, as you know from the news, cocoa and coffee prices have been historically high. That high beverage prices were only partly offset by food commodity prices that declined by about 9% in the third quarter of 2024 compared to a year earlier. And the decline in food prices was primarily led by grains and oilseeds. Grains, for instance, declined by about 15%, whereas the price of oilseeds in the same quarter, 2024, third quarter, declined by about 11%. And the main reason driving decreasing in grains and oilseed prices is bumper harvests, good growing conditions, as well as good harvest in the 23-24 season, as well as 24-25. Next slide, please. So this is what I was saying, that we have seen, or there is estimated that we will have record high production for maize, wheat, rice, and soybeans in the 23-24 season. And for 24-25, we also expect another record high production for wheat, rice, and soybeans. And growing conditions have been favorable and in some cases exceptional in most parts of the world, except parts of Europe and the Black Sea region, where we see some dryness. The next slide. So as a result, prices have been falling in 23-24. As I said earlier, food prices have declined by about 9% in 2024, but we expect a modest decline in 2025 with some stabilization in 2026. However, with regard to beverages, compared to the historically high prices in 2024, the reduction in prices is not going to provide a lot of relief. We expect about 10% of reduction in beverage prices, which is not that much compared to close to 60% rise of prices we have seen in 2024. But we expect prices to also be stable in 2026. Raw materials, agricultural raw materials for us are mostly cotton and natural rubber. They have been stable in the last couple of years. This year, and they are also expected to be stable in 25 and 26 as well. But this overall trend that a bigger decline in 2024, followed by a modest decline in 25, with some stabilization in 26. This is a common trend across different sub-indices of food, particularly grains and oils and meals. The next slide, please. Yeah, we also follow the stock-to-use ratio. This gives us an idea of the supply availability relative to demand. And stock-to-use ratio has been historically high for soybeans. It is expected to be higher in 24-25 as well. It is expected to be stable for maize and rice, and to decline slightly for wheat. Particularly for soybeans, as I said earlier, it has been increasing. There was a record high production in 23-24, and on top of that huge increase, we are also expecting another big harvest in 24-25. So we expect at least the U.S. Department of Agriculture data shows that the stock-to-use ratio for soybean in particular would exceed the 2018-2019 stock-to-use ratio. As you remember, 2018-2019, because of trade tensions between China and the US, that is when we have seen a very high stock-to-use ratio, and we expect 24-25 the stock-to-use ratio to be slightly higher than what we have seen in 2018-2019. Next slide. On the other hand, fertilizer prices have been declining overall. They have declined by about a fifth in 2024, the third quarter of 2024, compared to a year earlier. But if you look at just quarter to quarter, they ticked up a little bit in that quarter. But they have come down significantly from the highs of 2022 after the Russian invasion of Ukraine. As a result, fertilizer affordability has improved. The way we measure fertilizer affordability is as a ratio of fertilizer prices as a ratio of food prices, to have a rough idea of how the relative price of fertilizer compared to food. And that affordability index has come down to the 2015-2019 pre-COVID average. Next slide. Well, as I said earlier, beverage prices were the ones that were on the news as well, that have jumped significantly in 2024, and one of which is coffee. Robusta coffee prices in particular almost doubled from a year earlier. That was partly due to El Nino related weather concerns and production concerns in Vietnam, which is, as you know, the first Robusta coffee producer. For Arabica coffee, it has also increased by about 40% due to some weather concerns in Brazil. But the condition in Vietnam is improving, so we are seeing in the last few months Robusta coffee prices tickling down, even though that is not exactly the case for Arabica coffee, as there has been some fresh concerns of dryness in parts of Brazil. Overall, though, we expect global coffee production. The data shows that there will be some kind of increases in coffee production in 24-25 as well. The next slide. And cocoa is the one that jumped significantly. It nearly doubled in the third quarter of 2024 compared to a year earlier. Even though it has come down by about 20% in the third quarter, it is still significantly higher than historical, what we have seen in the past. It has reached close to $10 per kg, even though now it has come down to about $6 per kg. That is still significantly higher than the $2 to $3 that we know that we are used to. Cocoa prices particularly shoot up because of El Nino related dryness in West Africa. As you know, Ghana and Cote d'Ivoire in particular, the two countries account for about 60% of cocoa production. So that dryness, along with some pest issues, disease issues, plant disease issues, shoot prices higher. But the situation is improving a little bit, and hence prices coming down. The next slide. In terms of risk, still these forecasters, price forecasters are subject to different upside risks. Usually when you deal with agriculture, it's about extreme weather as well, particularly heat waves. We have seen a number of instances of heat waves that affected commodity prices this year. The escalation of conflicts in the Middle East, if it pushes energy prices higher, then that will lead to higher fertilizer prices and, of course, as a result, crop prices. On the downside, as Paulo was mentioning earlier, that if energy prices decline significantly as a result of some supply management, then that could reduce the demand for energy feedstocks such as sugar, soybean oil, palm oil, and maize as well. So that could also be a downside risk. We have assumed in these price forecasts a short and weak La Nina event, but if it turns out to be La Nina turns out to be strong, then even though the impact is not uniform, in some places, for instance, in South Asia, it might lead to better rainfall and it could push rice prices down. And if you have questions, I obviously I will get back to all parts of the presentation. I'll give it now to my colleague Jit. Thank you.
Thank you, Dawit. I'll now turn to metals and mineral markets. So for metals and mineral markets, we cover two broad sets of metals. The first relates to base metals, which typically include your 6 base metals. So that's aluminum, copper, nickel, tin, zinc, and lead. And then we have another group, which are the sort of the precious metals. So that's gold, silver, and platinum. So regarding the base metal group. So what we've seen for the last quarter is a 6% decline in our base metals price index. And that decline was pretty much broad-based across all metals. The largest decreases were seen for nickel, lead, and copper. And we also saw a significant decline in iron ore prices. So iron ore prices fell by about 12% quarter on quarter in Q3. If you look at the chart on your right, you'll see that the decline in base metal prices came after a significant increase in prices in Q2. And the increase in Q2 prices was largely reflective of copper prices. So what happened there is that coming into 2023, you had a lot of concerns about copper supply. And then in May, that was followed up by a speculative rally that pushed copper prices to near historic highs, which increased prices significantly. As you can see, the red line on that same chart has been consistently declining. And in fact, iron ore, which it represents, has been the worst performing metal for the year so far. So iron ore prices have been down by about 30% year to date. So what has been some of the key drivers behind the recent weakness in metal prices? So first of all, China plays an outsized role in metal demand. So China accounts for about 60% of global metal demand. So therefore, economic activity in China, growth, activity in the real estate sector, manufacturing, and so on, is a good indicator of global metal prices. So what we have seen so far for the year is that overall growth in China has been edging down, and more relevant is the continuous decline in real estate investment, as you can see on the chart on your left. In addition to China-specific data, we've also seen persistent weakness in global manufacturing activity. So if you look at the middle chart, where we have the global manufacturing PMIs, we can see that global manufacturing PMIs have been consistently negative territory. That's the line below 50 from July this year. So this sort of indicates sort of a general weakness in global manufacturing activity and a particular weakness in industrial activity in China. Now that against supply conditions, which have been improving. So we've seen improvements in production in the first half of this year, particularly for nickel, tin, and copper. So it's sort of this is sort of a continuing trend from the first half of this, from the second half of last year, where we've seen a continuous improvement in supply conditions against the backdrop of weak demand, which are accounting for the declines in prices we have seen recently. Now, looking ahead, we are projecting that base metal prices will broadly stabilize in 2025 after increasing by about 6% this year, and it will edge down by about 3% in 2026. So our underlying assumptions for base metal prices is that on the demand side, we're expecting that economic growth, global growth, will remain relatively subdued, and growth in China, given its important role in the metal market, is expected to average just around 4% over the forecast horizon. So that's significantly lower than in previous years. We're also assuming continued weakness in the property sector. For iron ore, we are projecting a continuous decline in 2025 and 2026. And this is largely related to, the continued weakness in China's property sector, given that iron ore is primarily used to produce steel and is an important input for construction starts. On the supply side, our assumptions are for a continuous improvement in supply conditions for several metals. So we expect several new mines to come on stream, particularly in South America and Africa. In addition to that, we also expect smelters in Europe that have had to reduce production due to the war in Ukraine that had led to an increase in energy prices. So we expect some of those smelters to come back on stream, and that will help boost supply, especially for those energy-intensive metals like aluminum and zinc. So overall, we are projecting sort of a steady decline in metal prices in the coming years. Now turning to precious metals. Our precious metals index increased by about 6% in the last quarter, and that was largely driven by gold. The story with gold for this year, as you're aware, is that gold prices have been breaking multiple records, and gold prices now stands at about 80% above pre-pandemic levels. So that's the average between 2015 to 2019. Silver prices have also been boosted by similar factors driving gold. And in fact, in the last quarter, silver prices edged up by about 2%. Now, regarding gold, which accounts for a significant weight in our precious metals index, there are sort of three key drivers supporting gold prices. So the first is this sort of a strong official demand. So we have seen an increase in central bank demand. In fact, central bank demand for gold has doubled in the last 4 to 5 years. So in 2023 and 2024, you had more of a doubling of gold demand by central banks compared to the decade before. The other important factor, and Paulo had mentioned some of this earlier on, is a heightened geopolitical tensions. So on this chart, we plot some of the important conflicts. So especially in the recent years, so looking at after the pandemic, you've had the Russian invasion of Ukraine, the conflict in the Middle East. And then in addition to that, you've also had for 2024, you've had a record number of elections in major economies. So together, all of these factors help to support safe haven demand, which has been an additional boost to gold prices. In terms of going forward, we are forecasting our precious metals price index to broadly stabilize and edge down. And that's largely due to our assumptions around gold prices. So we're expecting gold prices to edge down in 25 and 26. On the demand side, the assumption here is that given that gold prices are already at record high levels, we expect a slowdown in demand from jewelry and also official demand. So we've already seen signs of slowing jewelry demand in the last month or so, and central bank demand is expected to stabilize. In fact, China's central bank has paused buying since May this year, while other central banks have continued to buy. But our assumption going forward is that gold prices will sort of stabilize at relatively high levels. On the other hand, the other two precious metals, platinum and silver, both have dual uses. So as a financial asset and also critical inputs for the energy transition. Silver, particularly for solar panels, and platinum for hybrid vehicles. So we expect further support for demand for those two metals. And given the already tight supply conditions, we expect that to support higher prices going forward. Now, so given those baseline assumptions and our baseline price forecast, we have identified some key risks on the upside and the downside for metals in general. And so obviously, given China's outsider's role in the metals market, activity in China will have an impact, a big impact on the direction of prices. So there's quite a lot of discussions about a strong fiscal package from China that could potentially stabilize the property sector and could be supportive of manufacturing or metal intensive sectors in general, to the extent that it materializes. And that could be very supportive of metal demand and hence prices. Another typical source of risk, upside risk for metals, include production disruptions, and those could be, labor disputes, protest, power disruptions. So those could be supportive of metal prices. In fact, what we've noticed in the last year or so is that those metals that are important for the energy transition, in particular copper and nickel, they have been highly sensitive to news about production disruptions. And then the third bucket of upside risks include trade restrictions. So, in the last 5 years or so, there have been a number of trade restrictions on metals, including export bans to other export restrictions that could limit the supply of raw materials to the market, and this could put additional pressure on supply and upward pressure on prices. On the downside, again, given that China accounts for about 60% of global demand, any further weakness in economic activity, industrial activity in China could put downward pressure on metal prices. So I will just sort of quickly summarize the key messages of the CMO. So in terms of recent developments, our overall commodity price index, as we mentioned before, fell in the last quarter, but it remains above 40% compared to pre-pandemic levels. And this decline was largely broad-based for both energy and non-energy commodities. Regarding the outlook, we expect prices to fall further in 2025 and 2026, with larger declines for energy commodities compared to non-energy commodity groups. In terms of the key risks, so we see that the key risk to our price forecast include escalation of Middle East conflict, and this is relevant for energy and gold. Demand conditions in China, which are relevant for base metals, iron ore, and energy, and then extreme weather and energy prices, which are particularly important for agriculture and natural gas prices. So I'll stop here and I'll hand it back to you. Thank you.
Thank you very much for your presentation summarizing the key findings, key messages of the latest edition of the Commodity Market Outlook, October 2024 edition, which was released about 2 weeks ago. We received some questions in advance, and also some questions came during the presentation. And we do have about 10 minutes asking you to make responses. So let me read actually question, all of them together, and then ask each one of you to come in to respond to the question related to the area where you presented out of the report. So first question, this is more or less related to the geopolitical risk question. Question from Sasaki-san in advance that we received. Thank you. Would you please mention the impact of geopolitical and geoeconomic risks to energy, agriculture, and metal prices caused by the result of the elections in key developed countries in short, mid, and long terms? And also the question from Professor Yoshino related to the geopolitical aspect is this. Geopolitical risks are rising in Asia, facing with North Korea and Russia. What would be the best policy to cope with geopolitical risks? Should Japan increase domestic production of agricultural products despite its high cost of production? So this was a question from Professor Yoshino. Let me continue to read the other question. Sorry, I'm messing up my computer screen. Sorry about that. Where is this? Okay, this one. The question that we received in advance from Sasaki-san, thank you for your question. Food security in Africa, food security in African countries for the next couple of decades to feed the growing population seems challenging. From your current analysis of agriculture commodity market, what would be the best scenario to achieve this goal? So this is first question. And another question from him is this. In terms of the industrial activities in China slowing down, do you see any sign of industries, factories moving away from China and settled in other parts of the world for better conditions? This is another question. And then a couple of other questions from Professor Yoshino. Thank you for your question. Let me read. What are the long-term perspectives of energy prices as renewable energy increases? And another question from him. There is a discussion to charge tax on CO2 emissions. If tax is charged or the tax rate is increased, how would it affect the fossil fuel market? And then one final question from Yoshino Sensei that I just received. The metals and mineral market seems to have easier supply controls than agricultural product. If demand is falling, supply can be reduced much more easily than for agricultural product, which seems to lead to fewer price fluctuations. So this was a comment, I think. But so these are the points that we received from the viewers in advance and also during the presentation. So I would like to pass the microphone to three of you to somehow orchestrate among yourselves to respond to those points. Thank you very much.
I can start perhaps on the energy questions. There are quite a few of them for agriculture, which is I'll leave it to the wheat and a couple on metals. So in terms of a clear energy question, it would be the one related to long-term perspective of on the energy prices, renewable energy increases. We would consider that having a calming impact, so a downward impact on prices, just because as renewable energy becomes more prevalent in the market, the demand for fossil fuel will decrease, and as a consequence, assuming a supply is relatively constant, at least in the short term, we would expect a kind of a decrease in the price. That is not a philosophical question, but it's very much what's happening actually in China. And I mentioned the very relatively small increase in oil consumption in one of my slides. That is very much due to the penetration of electric vehicle in the car fleet, and also due to the penetration of natural gas powered trucks. So that is actually something which is happening right now, let's call it that way, something which is there to stay, and therefore that's one of the reasons why we see very high level of surplus in the market in 2025. One way to facilitate this kind of transition to renewable energy is through increasing by introducing a charge on CO2 emission, either a taxi or an ETS emission trading scheme. Well, it doesn't. The impact of either measure is to change the relative prices between CO2 emitting and non-CO2 emitting fuels. Therefore, the price of CO2 emitting fuels is increased. Therefore, with that, we would see a kind of decrease in demand, essentially. And therefore, we create a wedge between the price to supplier, the price to consumer, which includes the tax, and the price to suppliers, which doesn't include the tax. And therefore, that would make also, that would reduce also incentive to extract oil. Maybe another thing I can say a bit is about geopolitical risk. I mean, there was a question about geopolitical risk on agriculture and metal prices, and that I will leave it to Dawit and Jeet. But there was a general one in terms of on energy. I mean, in the main risk arising from the results of the election is perhaps we can focus on what has happened on instead of what might happen, and what has happened is the return to power of Trump. And in that regard, there is a clear two potential outcomes. One is that supply from the United States oil shale industry might increase because of more favorable environmental conditions. On the other, so that would increase even further the supply that we see coming to the market. On the other hand, there could be a more thorough implementation of sanctions on Iran, and as a consequence, that would have a restraining impact on this amount of oil made available to the market. What is the best policy for to deal with geopolitical risk? Well, it really depend, I suppose, on the nature of the risk. If it's a short-term one, as we saw, for example, in relationship so far, in relation to the Middle East crisis, to the recent conflict in the Middle East, which has, not very not very long-lasting sort of risk, then I suppose some sort of storage, increased storage might do the trick, because that would imply that any momentarily reduction in supplies can be managed by countries by tapping on the storage. If it's a long-term one, where we talk about years, then I think storage can go only so far. And in that case, a policy like energy efficiency or reducing consumption would be actually the best way to insulate one's economy from this risk. I'll pass it to Dawit or Jeet.
Paolo. Just quickly, I think in terms of the results of election on agricultural prices, I think the one that is highly that can be affected is soybeans. As you know, soybean is the highly traded agricultural commodity. So if there is, and China is the largest buyer, it's a big buyer of soybeans. So if there is by the new administration, if there is some tendency of putting tariffs, and there are tit for tat type of tariffs, then we have seen this in 2018, 2019, that soybean prices could be affected, but this is something that we have to wait and see. In terms of the other question about what to do to improve food security in Africa in particular, there are a list of many of options and recommendations over the past many years. The first one, of course, is enhancing agricultural productivity. That means, investing in fertilizers, improved seeds, agrochemicals, and other technologies. But increasing productivity is just one answer. The other part is then investing on strengthening marketing and agricultural value chains. How you do that? Then you have to invest again on transportation, on storage, on processing facilities, and other digital and physical infrastructure in general. That is the second component, marketing, productivity marketing. And the third component is really improving resilience, because in most cases, the food insecurity problem has to do with not being able to withstand when a shock happens, when drought happens. That is when things become really tight. So how do you do that? Then you have to invest on irrigation, you have to invest on drought tolerant seeds, you have to invest in R&D, you have to invest in agricultural extension, and you have to have some supportive policies. But when it comes to the other component, then is it's always difficult to ensure, it's not always possible to ensure food security by only production. So there has to be a room for trade, commodity trade. Of course, that would require having the ability to actually make the payments. So there has to be some healthy balance of payments to actually use the global commodity market as well. This is in general what I can say. Let me leave the next questions to Jeet. Thank you.
Thank you, David. So regarding metals, so there was a question on the geopolitical risks in relation to elections on metal markets. So in response to that, I would say, so given the sort of the orientation of policy after the outcome of the elections, which is a bit more sort of trade restrictive. So to the extent that those trade restrictions create headwinds to global growth, or in particular growth, economic activity in China, this could slow demand significantly for metals. In addition to that, if there are any significant shifts in policy that could potentially further slow the pace of the energy transition, for example, reducing incentives and so on for critical mineral projects, development of new technologies and so on. So this can also slow both investment in developing new sources of supply and also the demand trajectory for important metals such as copper and that kind of thing. So to the extent that those outcomes drive policies that create headwinds for growth, that could be provide downward pressure on metal demand and prices. There was also another question about industrial activity in China in relation to shifting activities from China to other countries. So I would say in the context of metal markets, the decline in industrial activity that we see in China largely stems from weak domestic demand, in particular the weakness in the property sector. I mean, there may be some marginal or gradual shifts in manufacturing activity, but I think for our commodity markets baseline and also forecast, we think the key issue there is sort of domestic weakness in China's economy. So I will stop there. Thank you.
Thank you very much. Connecting us from Washington this morning, Paolo Agnolucci, Jeet Kardan, and David Mekonnen, the senior economist from the Prospect Group of the Development Economies Vice Presidency of the World Bank Group, presenting the main findings of the Commodity Market Outlook October 2024 edition. Thank you very much, three of you, for your time to present and answer all the questions that we received. Thank you. Really appreciate it. Thank you very much.
Thank you all.
Thank you very much. Great. Okay, so we continue organizing these online morning seminars. Tomorrow, in fact, we are going to feature the Africa's Pulse which is an Africa version of the regional economic update, which was released a month ago. We are going to feature the Cesar Calderon, who is a lead economist in the office of the chief economist of Africa regions. And this is going to be 8 a.m. tomorrow morning in Japan Standard Time. Thank you very much. See you tomorrow morning. Thank you.